Hello, everyone. Welcome back to another episode of the Opportunity and the Empire Flipper Show. I am your host, Gregory Elfrink, the head of marketing over here at the Empire. And today I have a very cool guest, Ignacio Villanueva. He's the head of partnerships over at Boopos that helps companies get funding. And in a very interesting way, like you don't have to have a personal guarantee. It's all based off of a percentage of revenue. So it can go up and down with you in terms of volatility to help serve your capital needs. And we go deep on a bunch of different questions I had because I always find financing so intriguing. And if you are an entrepreneur that is afraid of going into debt for the business, well, you should listen to this episode because debt doesn't have to be your enemy. It might be your best friend. Let's talk about it. See you on the other side. All right. I got Ignacio Villanueva with me, and I'm very excited for this interview. We've done a lot of work with Boopos in the past, Ignacio, as you know, between our two companies. So before we dive too deep into Boopos, though, introduce yourself to our audience and where you are in the world right now.
All right. So first of all, thank you very much for having me on the podcast and letting the opportunities to Boopos to kind of talk about our product and what we could do. So as introduction about myself, I'm Ignacio, as you mentioned. Right now, I'm in a small town in Spain. I said northeast of Madrid, the capital. And I was talking to you before, and funny enough, this is my wife's town, and their grandparents are the only one living in the town. His grandfather
It's wild.
it is indeed. He's 90 years old, and he's obviously the mayor of the town because they're the only two couple that lives in the town. It's a very, very old town. It has a castle and everything, but it's super cool.
So your grandpa-in-law is the mayor of a town of just him and his wife?
Yeah, that's exactly what
That
it
is
is.
awesome. That is awesome. Before we started the podcast, I mentioned I'm from Alaska originally, and I didn't tell you this, but there is a town in Alaska named Talkeetna. I don't know if this is still the case, but it was the case years ago where the mayor of the town was a cat. So all the people would just come together and vote that this cat to be the mayor. But I
Oh,
think the
really?
cat finally passed away. So I don't know if there's still a cat or a dog who's the mayor of Talkeetna anymore, but that kind of reminds me of that.
I mean, when you have a town where that nobody wants to live there, it's just abandoned. Basically, you could do whatever you want, right? And this is the case.
That is awesome. Do they ever go into the castle? Do they live in the castle sometimes?
No, they actually don't. It's a small castle. It's actually for sale now. It's been for sale for a couple of years now. Obviously, nobody wants to buy it. They just live in a really small house right next to the small castle. I should perhaps like take a picture and
Well,
post it on Empire Flippers, a Slack channel that we have.
so I have a new objective by the end of this podcast. We're going to educate people about Boopos and financing all this stuff, but the real objective is now you and I to partner in buying a castle together. So like whatever we can do to get funding for that, that's the real objective now of this podcast.
Absolutely. We have Boopos and we have Empire Flippers
I got
Capital.
the
I mean,
Empire. Like this is perfect. This is great marketing. Empire Flipper show at a castle. Well, awesome, man. Give me the 30-second pitch of what Boopos does.
yeah, so basically, Boopos enables buyers to acquire companies, right? And the idea really behind our product is we want to take the sophisticated product of leverage buyout, where we've seen private equity firms and private companies do all their lives, and kind of enable the individual buyer to acquire companies by leveraging their capital, right? So basically, what we do is we enable buyers to acquire companies without putting as much capital as the eventual asking price is, right? So if you want to buy a business worth 1 million, obviously there's not a lot of people that has 1 million in their bank account just sitting around. So basically you can leverage your capital, put 200,000 down, we will finance the rest, and then ultimately you could do this multiple times, create a roll up, and basically acquire companies without putting so much capital, right? And we do this through a model that's called revenue based lending that we can talk about now.
Yeah. So let's back up just one step here. So
Mhm.
before we talk about revenue-based lending, how did you come into this position at Boopos? Like, what's your background in all of this?
Right. So actually, my background is a bit weird. I was a professional rugby player for many, many years, more than 10 years. I actually went to Olympics 2016. So up until
Wow.
2016, the only thing I did was play rugby, right? I actually went to try out for the NFL for the Steelers and the Buccaneers. I had two tryouts, didn't succeed. And after that, I stopped playing rugby. I always study. I studied business and law in university. So when I started playing rugby, I said, okay, now I want to start working at a startup. I want to get into the finance world and I want to get into the entrepreneur world. And that's how I ended up in Boopos. Actually, Boopos, I was first one in, first employees, the three co-founders, and then it was me since day one. So I've been here since very early on.
Wow, that's awesome. I don't think that's that weird. When I think business financing and lending, I often think of rugby. So it's the rugby of the financial world. Lending to entrepreneurs can be a bit rough, bit volatile.
It is actually,
That's
but I
awesome.
mean, sometimes, I mean, if you had a sports career, you would think that you would end up doing something related to sports and not really finance. So that's why I mentioned it's a bit weird.
I hear you, man. I mean, I used to be an oil field roughneck drilling for petroleum, and now I do internet marketing. So I'm with you on the strange transitions.
Right. I
I
mean,
feel, I feel you.
we can send out a shout out to every human resources employee out there that hey, no matter where you come from, you could always kind of adapt to look for something new, right?
Yeah, exactly. So let's talk about revenue based financing. What exactly does that mean? I'm assuming this is not like, a typical personal guarantee loan, or maybe it is. So tell me what the difference is with revenue based financing and normal financing.
Yeah, so revenue-based lending, I mean, basically what we see on especially e-commerce and a lot of marketing, so online assets, is that you're selling, let's say, Christmas trees, right? You're most likely going to do all your sales in the last quarter, right? During the Christmas time and during the summertime, most likely your sales won't be as high, right? So we wanted to come up with a financing that would enable basically owners or buyers to pay comfortable as their revenues grow or decrease throughout the year, right? And that's exactly what revenue based lending is. We're basically getting a percentage of your revenues on a monthly basis until you're able to repay fully the loan in within about 5 to 6 years, right? So given that we're taking a percentage of revenues, when your revenues increase, you will pay a little bit more money, but when your revenues decrease, since you're paying a percentage of revenues, the amount of money you have to pay back that month also decreases. You're not going to pay like fixed installments like traditional banks we're used to. Rather, you're just paying a percentage of the revenues. So the repayment of the loan, it's going with the profitability of the company. And if you're just growing, it's going to take less time for you to repay the loan. And as we will see in a few moments, we're going to have prepayment incentives instead of penalties, right? So you're going to be able to repay the loan earlier and pay less money ultimately.
Yeah, I like that. I like the flexibility with that because I know a lot of people do the more traditional financing for a business, which often the rates are really bad with a traditional bank, and there is no movement. Like usually when things go worse, they charge you a higher percentage, not like the lower amount, right? So I do like that. In terms of collateral, like usually there is some sort of collateral involved with a lot of this type of lending. What is the collateral for Boopos here? If someone did a loan with you guys.
Yeah, so usually what we've seen throughout the life of most loans, they get always personal guarantees, right? When you trying to get a loan, you have to put your house as a personal guarantee, right? However, with Boopos, we wanted to get rid of every personal guarantees that might be attached to an acquisition loan, right? So the only collateral we have is the assets that you purchase, right? Ultimately. So you're getting a loan to purchase those assets, and we're going to have those assets as collateral in case of default, but nothing else. So if you have, let's say, two e-commerce brands, you're trying to buy a third one, and you default on that loan, we're going to get just the assets of that third loan, yeah, and we will not go against your other assets, not your house, your car, everything will be safe. It will be just the assets that you eventually acquired using our loan.
Gotcha. So you would basically effectively take over that third business, the FBA business that got the loan, for example. You
Right.
guys would start operating that as your own.
So that's it depends on the cases. We could do many things. I mean, we want to be friendly and as flexible possible, right? So the first thing we will jump in a conversation if we're seeing that your revenues are decreasing drastically every month and you're aiming for a default, we'll connect to the buyer, to our client. We'll try to come up with a solution. We'll try to figure out a friendly way to kind of avoid taking over the assets because we're not operators ourselves, right? That's the
Hmm.
the last thing we want to do eventually is take over anybody's assets, because then we would have to operate them, and that's not our expertise, right? However, given the case, there's a few things that we could try to do in order to mitigate our risk, which is basically operate it ourselves for a period of time. We could try to resell it. We could try to talk to the current seller eventually and talk to them and say, hey, we have the business that you sold, let's say a year ago, has been in default. You want to manage it again and take over the loan. I mean, there's
Yeah.
a different type of things that we could potentially do.
Yeah, that makes sense. And Boopos, you guys originally started off as an aggregator, I believe, right? Like that was the initial thinking behind it.
Yeah, so the idea behind Boopos, when Juan Ignacio, which is actually our CEO, he was the co-founder and CFO for a company called Cabify in Spain, which was the first unicorn in Spain. It was car sharing, so similar to Uber. He exited that
Ah,
company.
cool.
Yeah, so he first wanted to acquire companies in the e-commerce space. He talked to a few brokers, signed a few NDAs, and looked at a few deals. But he quickly realized that he didn't have that much experience managing the business, but he did have a lot of background in the bank industry as a lender and doing these leverage buyouts. So he realized, hey, why don't we just start financing the acquisition for people that actually know how to operate these brands? We will just focus on the
Uh,
financing and we will let people operate the brands.
to be honest, I think that was a super smart move on your guys' part. Like you guys came about right in the gold rush of the aggregator space. And I've spoken to a ton of aggregators. Obviously, they bought tons of businesses from us. And this is going to sound a bit of like an insult, but I don't mean it necessarily as an insult. A lot of the aggregators, I feel like they're really good at the financing side of things, like the M&A side of things, and they're really bad at running e-commerce businesses. So I think that was a smart move. You did a pivot because I'm sure aggregators even use Bupos at certain points. So I think that was a very smart, more blue ocean move of you guys. I want to dive deeper into the finance stuff, but before I do, I have one question I meant to ask at the beginning of this, but it's always something I wondered. Where does the name Bupos actually come from? Does it mean something?
It doesn't mean anything at all. Actually, it was
I love it. I love it.
yeah,
That's even better.
it's very random. I think it was Juan's son that came up with it one day. It doesn't mean anything at all. And we first, it was like it's some love and hate, because when you hear it for the first time, you're like, why would you name a company Boopos? But then when you start seeing the logo Infinite, and you start to hear more and more, it kind of has a good vibe, a good sound to it. So
Yeah, it's
we've
fun to
grown,
say.
yeah, absolutely. So we've grown fond of the name eventually. Yeah.
That's awesome. I like that. There's a lot of companies that are very successful that I've talked to who they have the same thing. Like, how'd you name this company? And they're like, well, you just kind of threw a couple words together that rolled off the tongue and means absolutely nothing, but it helps us a lot in Google search because there's like nothing else named this thing.
I think that's our case.
But yeah, that's awesome. So I want to talk about two different lending types. So you have traditional funding and then you have SBA loans, and these are the two most common types. So with Bupos, we already kind of talked a little bit about this, but tell me what are the advantages of using, say, Bupos over that traditional funding or an SBA loan to acquire?
Right, absolutely. So I would say like the spectrum of the options that an individual buyer has when they want to acquire companies. And before Bupo step into the market, you could have, like, as you mentioned, SBA loan, more traditional 7A loan, right? Which we will dive deep into a little bit more. And then you have private equity firms. You can try to raise capital on yourself, right? The problem with that is that you have to dilute yourself, right? Every time you raise capital, you have to give away a percentage of the company. It's not very easy to raise capital. You need experience. That's something that the aggregators had the experience of raising capital. That's why they were able to acquire so many deals, because they had this experience raising capital from the market. However, they have to dilute themselves. It takes time also, right? So if you really want to acquire a company in the next week or so, forget about raising equity, because the timing is not going to be right. And then you have venture debt, which is a much more complex solution once you've raised equity and once you're kind of doing this roll up strategy, right? So going back to the SBA, the option SBA, I mean, to be honest, SBA is a great product, right? Because they always have the better terms financially, right? So if you could get the financial terms on SBA and put everything that Pupos does great, it would be like the perfect product, obviously, right? However, we're finding some difficulties that buyers are seen on SBA that rather takes them to use our financing rather than the SBA, right? Something that we've seen with SBA is that the process of closing SBA loan is just outrageous. It's at least 90 days.
Yes.
And it's,
If you're lucky, yeah.
if you're lucky, and it goes completely the opposite way of what the market on some of these online assets sell. So if you're a buyer that wants to acquire a company using an SBA, just know that most likely that seller will rather choose someone that has the money up front, that doesn't have to wait 90 days. I think the seller even has to do a lot of paperwork in order for the buyer to get qualified for an
Oh yeah.
SBA. So
We
that's
like sorry, yeah, this SBA thing. Whenever I think of SBA, it's like, so we actually, my sales team, they got back to me like, hey, why did we publish this thing about SBA? We never do SBA, but it was like a useful piece of content for our audience, which is why we talked about it, because there was a cool story of someone acquiring with SBA. But in general, I always tell people, do not use an SBA. It's such a long slog and it's horrible. Like the seller side, like a lot of times if the seller is like non-American, or if they did something wonky with their taxes, whether on purpose or not, like it just throws everything for a loop. And it just feels like you're waiting 90 days to 6 months. And by then the market's already moved on. There's all
right.
sorts of buyers coming in to buy that business anyways. You miss out on deals. Like for anyone out there in the audience listening, we've done actual deals with Boopos where we've closed the deals in reasonable time frames. We have never successfully been able to do that with SBA. It is a good product for sure, but I
Absolutely,
sometimes
yes.
wonder about its utility in our space.
That's something I want to clear about. I mean, SBA is a great product, but it just has some things. Whereas in the market that we are right now, it kind of makes it hard, right? And time being one of them, and the main one. Also, personal guarantees. I mean, not a lot of people,
Yeah.
first of all, has assets that they could put as personal guarantees, and also they don't feel comfortable with. I mean, even if you're first time buyer, even if you have a lot of confidence that you're going to be able to succeed the e-commerce and actually grow, there's a high chance that we get into a World War III, right? A big world recession, the world ends, right? And you want to have at least your house for yourself, right? So that's
Right.
being able to let your personal assets stay away from the acquisition of an e-commerce. That's very helpful, and we come across a lot of people that want to use our financing because, first of all, they know that we could close within 7 days and that we're not going to request personal guarantees.
Yeah, I love that. Personal guarantees, a lot of people don't realize how painful that can be. Like, especially in an online business when things go volatile. Like, I'd be the first to admit, I sell these businesses for a living, but they're volatile, right? But within that volatility is the massive amount of reward that and all the growth potential. So there's like upsides to it too,
Right.
right? But that personal guarantee thing, I think people don't think enough about it. Talk to me. So we,
But and
oh,
one
sorry, were
last,
you going to say
yeah,
something?
no, one last
Yeah.
thing about SBA is that we really understand that SBA could be a great product. So we help our buyers refinance with an SBA once they have acquired a company using our financing. So if you're really trying to acquire a company fast and you know that SBA is not going to deliver that minimum time for you to acquire a company, hey, why don't you just acquire a company using Boopos? And then once you're the owner, once you know that all the paperwork, you're going to be the only one doing it. And then once you know that you have all the
Mm.
time in the world, hey, you can think about refinancing our loan with an SBA loan. That's completely possible. And that's something that we will help you in the way of doing so.
I love that. I didn't consider that as an option. I think that's actually a good option because SBA is a good product, minus all the hassles and paperwork. Even when you factor in the personal guarantee, like I don't personally like personal guarantees, but in some situations it does make a lot of sense. Yeah, that makes sense. It kind of reminds me of almost a bridge loan in real estate, right? You get the like almost a hard money loan type of thing. Not saying you guys are hard money, your rates are way better than a hard money loan, but you use the hard money to buy the real estate and then you refinance with the bank because now you, like you said, it's just you who has to do the paperwork at this point,
Right.
which makes it much easier.
That's exactly what it would look like. Yeah.
Like I mentioned earlier, we've done quite a number of deals with you guys. We're a fan. We tried to do content like this, right, to get the good word out about Boopos. So those pre-approved number of businesses on our marketplace, what goes into that pre-approval process? Like what criteria are you looking for us to put that little financing badge on our marketplace? Because
Mhm.
for anyone who doesn't know, after a business goes in vetting with us and gets on the marketplace, that's when we send some of this data over to you to see if you would approve it or not to put that badge on.
Right, exactly. So I think it's worth mentioning is that we have an underwriting team that focuses on looking at each deal individually, and that each deal goes through an underwriting funnel in order to see if we are able to offer financing, and we'll eventually and actually look at each deal individually on our committee. So we have a committee every 3 committees a week, so we're basically looking at each deal very carefully individually, right? So the way it works is whenever you guys send us a bunch of deals that just are released into the market, we'll basically analyze it. We have a underwriting criteria. We look at a set of variables that we want to take into account, and then if the variables are good enough, that's where we'll approve a business. If the addition of the variables that don't add up to what we think are good enough, that's where we will reject the business, right? Some of the things that we look for initially is the business has to be profitable. We need at least 18 months of track record. Ideally, we want to get to 24, but if the business was first built 18 months ago, we will still be able to look at it. That's the minimum, and it will have to be profitable, right? So some of the variables we look at is how much cost of goods, what's the marketing expenses, how much they're spending on marketing, what's the cost of goods, what's the profit revenue ratio, how has that changed throughout the lifetime of the business, like last 12 months compared to last 6 months. We'll look at different variables, and we'll add basically a grade to each one of those variables, and then we add them all up on our system to see if it qualifies or it doesn't qualify for financing. And then we'll determine based on the cash flow of the last 12 months how much money we could actually deploy for the acquisition, and then what will be the percentage of revenue that we have to get on a monthly basis, so we eventually get repaid that same amount that we initially approved in 5 year time, right? So that's all we do when we look at the business, look at the variables, cash flow, determine how much we could potentially finance for an acquisition, and what's the percentage that you will have to pay as the buyer in order to repay the loan back in 5 years.
That makes sense. Is there a certain minimum deal size? Like, does the business have to be making a certain amount of money for it to be worth your time to do this, or is it just any profitable business?
So we do have a limit, I would say. So we'll try to look at deals that are at least 100,000 in annual revenues. So as long as the business is able to make that amount, then we will be able to finance the acquisition.
100,000 annual revenue.
Yeah.
Wow, that so
So
that can go down to pretty small then in terms of like valuation size, say like a margin of 30% or so that a lot of e-commerce businesses have. I mean, that's super reasonable. That's lower than I expected.
it is
Um,
indeed. I think the lowest loan that we've lent to an acquisition on Empire Flippers is around 40,000, something like that. And the price, obviously, we cannot lend more than 80% of the purchase price. I think that's the smallest deal we've done so far.
That's awesome. So this is a tool that a lot of people in our audience can use. People are just looking to start out. They want to use some OPM, other people's money to leverage themselves in. That's awesome.
That's absolutely
Um,
the idea. And
real,
then on the higher end, which I think is also worth mentioning, sorry to kind of cut you up there, is that we can lend up to
oh, no.
2 million per deal in facility, right? So that means that we could potentially finance 50% on a $2 million deal, right? And if you're creative enough with how you structure the acquisition, you could acquire a pretty big deal, let's say $4 million deal where we're financing 2 million, you're putting 1 million equity, and then you're leaving 1 million seller note, right? So there's a lot of ways to
Wow.
get creative with our financing. We enable buyers and sellers to agree to a seller note. So there's plenty of ways to acquire really big deals and really good deals using our financing.
That's awesome. And when it comes to the rates, what kind of interest rates are you guys charging?
Yeah, so good question. The thing with our financing, and let me see if I can explain it in a way that it's pretty understandable. We don't actually have
Sure.
interest rates. What we have is cap rates. So basically, we have ceilings, right? When we analyze a business, we are assuming that the business is not going to grow. So we're accounting for the business to stay the same as the revenues in the last 12 months, right? So what we see is we say, okay, you can pay it back in 5 years. However, we're going to give you options to prepay early in case you grow the business or in case you want to restructure with an SBA, as we mentioned earlier, right? So, what we have is cap rate, which means if you're able to repay 1.15 of the lent amount in 1 year, you're basically can cancel the loan, right? So sorry, there's
Mm.
just there's a fly.
The other resident of the Spanish village, the fly. He heard us talking about buying his castle. He's pissed.
So yeah, basically, if you're paying 1.15 of whatever amount we lent within 1 year, you basically cancel the loan. That will be like your cap at first year or a ceiling, right? We can call it. So you're basically paying every month, but if you are able to reach to that ceiling, you basically cancel the loan, right? So 1.15. Then the second year, the cap at second year is 1.30. So if we lend 1 million, let's say you want to pay it back in 2 years, you're paying 1,300,000, which is 1.3 of the lent amount, right? And then we have year three 1.45, and then thereafter we have a cap of 1.6. So even if it takes you 5 or 6 years to repay back the loan, you're still going to pay 1.6 of the lent amount. It's not like the amount that you have to pay back increases. So the good thing about our finance is that you always know how much you have to pay back, and you always know that you're going to have an option to prepay early in case you grow the business or in case you find a cheaper source of capital or a more adequate source of capital for you. Even, I mean, SBA, I know we offers up to 10 years, so perhaps you'd rather go with an SBA after the second year. That's
Yeah.
completely fine to us.
So you threw around 5 years a lot there, but you also said 6 years. So do you try to make the loans each 5 years, but you're flexible on that?
Yeah, that's a really good question. Something that I like to address because we've had that back and forth with our clients asking the same question. So when we underwrite a deal, when we analyze the potential of the business to repay back the loan, we usually set it up so the repayment, the fully repayment is in 5 years, right? So we'll look at the revenues, the profit revenue ratio. We'll say, okay, if the business stays the same, if we're getting, let's say, 12% of your revenues, you're going to pay back naturally within 5 years, right? And at 5 years, you're going to
Yeah.
basically cancel the loan. However, let's say you decrease revenues at some point. So we
The
don't mind.
ultimate business strategy.
Right. So if it takes you more than 5 years because the revenues haven't been the same as when we first analyzed the business, you're going to have 6 years to repay back the loan without any charge or anything changing. That's why we say between 5 and 6. But ultimately, we're thinking that if the business stays the same, you will pay it back within 5 years.
Yeah, and at the end of the 6 years, is that when it is just automatically defaulted at that point, or as long as you keep paying, it doesn't default, or how does that work?
So we have a default where revenues cannot decrease 20% year over 5 consecutive months.
Mm,
But eventually, if you think
gotcha.
about it, I mean, your revenues could decrease 10% ultimately, indefinitely, right? And you will not pay more money. So it's just as long as
Right. Yeah. Yeah.
you keep paying the loan back, and we're going to be flexible.
Gotcha. That makes sense. In terms of business models, I know you guys started off with basically only Amazon FBA back in the day. Is that still the case, or are you now financing other types of business models as well?
Yeah, so we do finance. So FBA, e-commerce, SaaS, those have been our three main type of assets that we financed initially. We have now opened the door a little bit to content sites and marketing agencies. However, when
Mm,
it comes to content and so when it comes to content sites, we qualify the buyer and we make sure that the buyer has experience managing the business and that he can really demonstrate experience managing content sites, right? Whereas when there's an e-commerce, we kind of don't mind if you're the first time buying an e-commerce. Where in a content sites, we would rather you having experience managing other content sites to feel comfortable. And then marketing agencies, we could also finance those. However, we have to understand the recurrence on their clients and understanding, okay, what's their client base looks like, how much they've been paying for your service, how long have they been around, basically, right? To kind of understand that client recurrence, just as if we would look at a SaaS and a cohort analysis, we would like to see that as well on a marketing agency in order to approve the deal.
that's interesting. So you vet the buyers on the content side more than the e-commerce so that they actually have experience. Is that because there's less collateral, like less hard assets, or because you guys are less comfortable with that model, or why is that?
Yeah, but also something that we feel is that, I mean, content sites are very attractive in terms of the profit margin revenues, right? So
For sure. Yeah.
when you have an experienced buyer looking to buy any online business, if you come across with a content site, you're going to be, this is super easy to manage. I don't have to deal with inventory. I don't have to know anything about content size. I'm just going to acquire it. And then all of a sudden, Google changes their algorithm or they have an update.
Yes.
Or we've seen it happen. That's why. So it's just a much riskier asset if the buyer doesn't have the required experience. And for that reason, we try to qualify the buyer a little bit more than e-commerce, which doesn't mean we don't
That makes
qualify the
a
buyer.
Of course, yeah, yeah. That does make sense. Google is an erstwhile foe on the best of days. So that's cool. I did not know about the content site thing. That is really cool. And you guys are obviously doing SaaS. Is there a similar vetting thing that you're doing with content with SaaS? Because I feel like SaaS can be a bit more not riskier than a content site, but the technical aspect of it, a lot of the buyers of a SaaS business, I would qualify as non-technical. So is that something you're looking at too, or how's your process work around SaaS?
Yeah, so we qualify the SaaS businesses. It's a very similar process than the e-commerce. So it's all part of the underwriting model and the underwriting process that we have. But yeah, you're right. It has to be more technical, the type of buyer. But we feel like
Yeah.
somebody that is not experienced buying SaaS is not as attracted to buy SaaS as somebody that's not experienced managing content size. He is when he looks at a content site. I'm not sure if
There's
I.
truth to that. There's truth to that.
So I
Yeah.
think there's something very technical on SaaS that kind of takes people a little bit scared when they don't have experience. Whereas on a content side, people are more confident that they can manage a content side without experience. Where the reality is
Yeah.
that you actually need a bit of knowledge to acquire both of the assets, right?
Uh, I mean, I'm pretty experienced as a marketer. Like, I think I'm pretty experienced to handle a content site, but me owning a whole SaaS business, I would be more resident on. I think some entrepreneurs, especially if they actually have a successful business that's not a SaaS, are like, oh, SaaS is the easiest thing in the world because they're recurring. And like, well, yeah, wait till the VC comes in with the new fully loaded up competitor that's going to destroy
Right.
you, right?
So,
So,
so what would you say
yeah.
it's your experience? Would you be able like in terms of the buyers that acquired e-commerce versus content size on Empire Flippers, what percentage would you say have experience managing these assets before they acquire them, and what percentage would you say are first-time buyers in that type of online asset?
Yeah, so content definitely is the place where most people begin. We've had people buy businesses with very little to zero experience with content sites. I would wager, though, probably 70%, 75% of people buy content sites have some experience. With e commerce, I would say is probably closer to 85% or so. So definitely people buy e commerce, they tend to have more experience with e com. And also, newbie buyers are a little bit more intimidated by the logistics of it all with e-com. Not always. We have a very funny story of this guy. He bought, I think it was a $2 million FBA business, and this was the height of the pandemic, so a couple years ago. And we asked him like, "So, what's your experience with FBA?" He's like, "None." Okay, what's your experience with online business? Never done anything. Like, okay, well, maybe we should look at like a 30K business to get your feet wet. He's like, no, I want to go big. Don't worry. I'm a real estate investor out here in Seattle. Just sell some crypto and buy it. Like, well, okay, do you have the wherewithal to buy a $2 million business? Like our sales guy was like pushing back, like telling me, like, you shouldn't do this. Like, don't do this. And the guy's like, yeah, no problem. Let's go big. I'm like, okay. So he ended up buying the business. It worked out great for him. The guy was like a natural. He just crushed it. So I think a lot of newbie buyers, when they look at e-commerce, they're more attracted to content because of like the hidden details of e-com.
Right.
But I do think in a lot of ways, e-commerce is easier than content sites in some aspects for a
Mm.
person starting out. Like once you figure out the basic fundamentals, it's a lot easier to scale e-commerce store than it is to scale a content site a lot of the times to the moon and back, so to speak, right? Of course, with content sites, if you're a pro, you can always turn a content site into an e-commerce store. I have a
Right.
good friend, Kevin Espirito. He did this with Epic Gardening. And now I think he just raised $17 million for what started off as just a little affiliate site, but now it's just like become a beast in its own right for the gardening niche. So
Mhm. That's actually we've seen that strategy before on content buyers, and that really seems to work pretty well. Because do you guys follow up after somebody acquires a company to see how they're doing 2 years after? Do you have any type of information on what's the ratio between success and not so much success?
yeah, so we did two studies on this actually. We tried to do three, but we couldn't get a hold of enough people. Usually, what happens if something went really bad, they're very happy to talk to me. to tell me what a piece of crap I was, basically, for selling them to this. If things are going well, they don't really want to talk about it a lot of the times. Like, I don't want anyone to know, or they're just like too
Uh,
busy. But we
I
did.
would say it would be the opposite way around, where if you're doing
Yeah.
something good, you're like, I want to talk about it. Whereas if you did something bad, you don't want people to know.
Yeah, the people who were really mad, they didn't give us anything useful to talk about, usually on the negative side. But so we did this study. It took us like, I think it was like 7 months, maybe a little bit less than 7 months to do it. Because we basically had a cold call through our whole list to get to these people. And the criteria was they had to buy it at least 6 months before the call. So at least some time had passed. I think the average was 1.8 years of time of them owning it. And
Mhm.
with content sites, I think the number, we'll link to this in the show notes. So we actually did ROI studies on this. So these numbers could be wrong. I'm just trying to remember them at the top of my head. But I think content site was like 73% either stayed normal or they grew the profit,
Okay.
which is really
Okay.
good. That's
It
a really
is.
good
It
metric.
is.
And for Amazon FBA, that was the other one that we had enough data to do the study on. And that I think was higher. I think it was like 78% or maybe even 80%, which is really also amazing, right? Like if you look at starting a business from scratch where you have no product market fit, no nothing, like the failure rate is basically 99%. I mean, it's like 94%, I think is the true number, but still 6% chance of success versus like 72%. Like I'll take the 72% every time, right? But yeah, we tried to do a third study that looked at all businesses, but we just didn't feel as good with the data on that one. We did publish an aggregate one, but we felt like that one was less useful.
Right. No, that's super interesting.
Yeah, yeah. We should go back and do that again. It took a surprising amount of work to put together that study. So shout out to my content specialist who spent weeks on the phone creating those. Cool. So in terms of getting back on track here with in terms of Boopos, what is some of the advantages of taking out a loan? Because a lot of entrepreneurs, they're raised to fear the debt, right? To fear the loan monsters, the loan sharks out in the waters. But in my experience, there's a lot less to fear there if you know what you're doing. But maybe explain that to your own words. What kind of benefits do people get by doing this?
All right, so absolutely. We've talked about the benefits going like the timing wise, it takes 48 hours to get pre approved, only 7 days to close the transaction. We don't ask for personal guarantees. That's obviously a good benefit. You don't have to dilute yourself. So, compared to other sources of funding, we could see the benefits of using Boopos, right? Not have to dilute yourself. Now, if the question is related to if you have, let's say, $1 million in your bank account and you want to acquire a company, why should you use Boopos instead of just using your own cash and obviously not paying whatever rates we have, right? And that's a great question. That's probably one of the toughest things to talk about to buyers and help them understand the power of leverage, the capital that they have, right? And to give you an example, or a true example, so I met a buyer a few months ago. He actually had sold his previous e-commerce. He had a $1 million in his bank account. He wanted to acquire a company, and he was looking to acquire a company worth 1 million, right? Because he had that cash sitting in his bank account. But one of my other clients made the introduction, so he jumped on a call with me just to understand and to talk to people, right? So I talked through how Boopos works, what are the good benefits of working with Boopos, and so far in only a few months, he has able to acquire three companies worth 1 million each, where we're financing 700,000 for each one of those acquisitions, and he's only putting 300,000 down, right? So if you
Wow.
see the result, he's used that same million that he initially thought to put into the acquisition, but rather than acquiring only one e-commerce, he's been able to acquire three companies, three e-commerce, right? So if you think of return of investment down the road, 4 or 5 years, even if the business stays the same, but if you're able to increase, let's say 10% year over year in some of these e-commerce, the return of investment of selling three companies compared to just one is just outrageous, right? So that's the power of using Boopos, is just to leverage your capital. So when you think of buying a house, right? Let's say you win the lottery right now, you win a couple $1 million, you go to the real estate market, you will never think of, hey, I'm gonna buy a house and I'm gonna put all the equity that I have into this acquisition, right? You're always gonna leverage and let the bank take most of the price, right? 80%, just like rich dad, poor dad, right? It's just like never use your
Right.
own money, always leverage as much as possible and have someone else pay for the vast majority, right? And again, going back to the initial conversation, leverage buyout. Private equity firms have been doing it for a long time. They never, when they buy a $50 million company, they never put in the 50 million, right? They'll just put in a small percentage of equity and they'll leverage the rest with debt, right? And that's exactly what that advantage of using Boopos is. If you're thinking of return of investment down the road, the more you leverage your capital, the more companies you're able to acquire. And then we could talk about diversifying your portfolio, your risk, start thinking of creating kind of a roll up strategy in that same product line, right? So let's say you have
Hmm.
500,000, you could acquire one company on the baby product, or you can acquire three companies on that same niche, that baby product, that kind of create like a bigger brand, create a portfolio, and actually create something bigger that is more sustainable, right? You could either, as you mentioned earlier, you could buy a content site that talks about dog food or dog products, and then you could buy an e-commerce that sells dog products, and then you can connect them both, right? So basically, using Boopos, the big advantage of using Boopos is that you have the power of leveraging your capital in order to create or buy bigger things. And then obviously down the road, if you follow that strategy, the return of investment is going to be so much bigger, right? And if you default and if your business, the worst case scenario, business goes to zero, it's worth nothing. We're not going to go against your personal assets. So you don't have nothing to lose, or you have very little to lose apart from the equity that you put down. But on the other side, you have so much potential that you could gain if things go well. So I would say
Yeah,
that's
that
the
that
biggest advantage.
Yeah, that's huge. You mentioned the real estate thing, so I'm excited that you and I are going to do this castle purchase and turn that into a content site. Like we'll
Right.
do the media together. We'll figure it out. We'll talk about after the show on the financing details. But in all seriousness, I think that is awesome. That story of the guy buying the $1 million businesses. You mentioned earlier you guys can do a debt facility up to $2 million, and I was initially thinking that's for one business, or is that for one borrower? Like you borrow up to $2 million to a single lender across all the businesses, or am I getting that right?
Yeah, no, so thanks for bringing this up because we can clear about it. So 2 million is per deal, right? So
Per deal.
yeah,
Okay.
so for example, another difference between SBA, once you pull 5 million from SBA, you cannot get more access to their loans, right? However, we have buyers that have acquired up to 10 companies using our financing. Now, for example, one company was 1 million, the other one 500,000, the other one 1.5 million, and they're just making acquisitions every month, right? So the total amount that we lend to them is greater than 5, 6, 7 million. But as long as we don't deploy that amount per deal, we were good to go. Even we've worked, and going back to the conversation we had earlier, we have worked with a number of small aggregators that have acquired 5 companies simultaneously using our financing. So
That's awesome.
we deployed more than 2 million in total, but they just made it through, I think it was 5 acquisitions simultaneously. So Boopos ultimately is not good for individual buyers that don't have the capital, but it's even better for people that have capital and want to leverage it to do more things and grow at a faster pace. And eventually you could always refinance the whole debt. So if you grow fast enough, if you acquire, let's say, 10 companies and you can create a good portfolio, that's when you can start raising debt from other lenders, equity, and using
Mhm.
that capital to repay us off. So there's a lot of strategies that you could follow and that we've seen eventually people following that strategy that works very, very well.
I bet. I mean, when you look at real estate investing, so I'm a real estate investor. I own a
Right.
house in Alaska, a place in Vietnam. Don't recommend buying in Vietnam. It's very complicated, not worth it. But in general, like if you look at the kind of cash on cash return you get from real estate, like a simple $100,000 single family home versus a $100,000 content site or e-commerce store, it's like night and day. Even if
Right.
you are using financing on the house, so your cash on cash return it should be larger. It still is just no contest in my
Right.
view. So this is awesome stuff.
So
In terms
compare,
of someone, go ahead.
yeah, no, I mean, compared to real estate. So let's say you buy a piece of land. It's obviously very safe to buy real estate, right? And we can get into the argument some other time. But let's say you acquire a property worth 1 million. Most likely you'll get a mortgage from the bank. You rent out the house for somebody to pay the mortgage out, but you have to wait 15 years until the whole property is basically paid off entirely, right? And you
Unless if you're
eventually,
going fast.
right, if you're
Yeah.
going fast,
You opt for the 30 years. Yeah.
and most likely you're going to use all the rent that you get to pay off the mortgage. However, when you buy an e-commerce using Boopos, we're thinking that you're going to repay the whole loan back in 5 years, right? If the business doesn't grow, but even you have the ability to make revenues grow. Whereas compared to a house, for example, you know that, okay, rent might be increasing year on year, but just a little bit, right? Whereas e-commerce, you really have a chance to increase it by a lot year on year, right? So eventually, after 4 or 5 years, the debt is already paid off fully and completely, right? So that means that if you buy a company, let's say worth 1 million, we're financing 800,000. After 4 or 5 years, you own a business worth 1 million or 1.2 if you're able to increase the business. So that's actually a much faster way to get the return of investment and have an asset fully paid off within 4 years compared to the 15 years that it will take you to fully pay a real estate asset.
Oh, for sure. And there's so many things you can do in the digital space. Like the idea of doubling your valuation, doubling your investment in any other like investment vehicle, like say stock market or real estate. Like you have to do some pretty risky, maybe illegal things to like get there, right? It's not usually worth it. But with the digital space, that's not that unreasonable to double a business, double traffic. I mean, for instance, this is an EF example, but I updated some on-page SEO for our evaluation tool, and I increased our organic leads coming through there by I think it was like 115, 120%, something like that. And like average business size around 400, $500,000 for that 30 minutes of work. Like that's huge, right? A huge increase that you can get with the leverage of the internet. And we combine with something like Boopos, that's some, pretty fiery fuel you got to go on there. If you, at least if you know what you're doing. So I want to ask you this question real quick, and then I want to get into my three final questions before we move to rapid fire. But if someone does loan, say several loans from you to buy out, like say 3, 5 different businesses, I mean, everyone knows entrepreneurship is risky. Sometimes things fail, even if the entrepreneur knows what they're doing. So let's say they do this, they get 5 loans from you. One of them goes really bad, but the like 3 of them go good, and one of them goes okay. How do you guys hold that against the lender if in case if they want to, or not the lender, sorry, the borrower, if they want to borrow again from you, but they did have one unsuccessful business? Is it like never again, or are you guys more flexible on that?
That's a great question. So first of all, I would say that you always have the option of prepaying at any given moment, right? So let's say if you have 5 deals with us and one of them unfortunately goes to default, you can use the capital from the other businesses to repay this loan up and just keep the assets just in case you're able
Yeah.
to bring back the revenues and kind of have work better with our relationship, right? And to answer your question, we don't have a specific answer to say, okay, once you have defaulted on a specific case, you cannot go back to us. It's just on a relationship level by buyer. So if we feel like, okay, you have acquired 6 companies with us, all of them are doing great. One of them, unfortunately, defaulted. We understand the terms. You've completely tried everything in your power to repay us. You were very communicative. You answered. You were willing to pick up the phone even when things weren't going as good as possible. And you're a buyer that's very easy to work with. Obviously, we can work on another loans, but if you're not
Yeah.
paying what you have to pay every month, when we send you out an email, you're not answering back in 5, 6, 7 days. We have to call you on the phone. We have to track you down. I mean, if you make it
They're
hard to
ghosting.
work,
They're hiding in the castle. Don't come
right?
here.
Exactly. So if if you're making it hard for us to work with you, that's something that probably will be on the table once you bring us another deal, right? So as long as you're a good person and you're a good buyer, then we could definitely look over the fact that one of the deals went bad.
Yeah, I'm glad you said it that way because I think a lot of founders they are super scared of taking capital and failing to pay back, and a lot of them would ghost them because they just think like, well, that relationship's ruined forever. But I think that's important to even if things are going bad to talk to your people because a lot of times people are way more flexible than you might initially think. And there's a funny statistic. I forget what the actual number is, but basically founders that failed, like founders that raised a bunch of VC capital that failed The second time they raise VC funding for a new startup, they often succeed. Their chances of succeeding actually go way up than the first time because of all the lessons they learned
Right. It's just
on the way
experience.
down the first time, right? Yeah. Speaking
But
of experience, let's talk about some. Oh, yeah, go ahead.
no, I would just want to say like ultimately we're just people and the relationship between people is very important, right? So if you're doing something that obviously we understand that things can go wrong, as long as you're still a person that can communicate and get in a conversation and deploy the bad news, that's definitely going to work in your favor when you work with any type of lender, not even Boopos, but also your bank or SBA
Yeah.
or private equity, when you're able to sit in front of the guy and be completely transparent on, hey, things are not going as expected. I'm going to work on this and that and that. And if you have any suggestions, I'm going to work as hard as possible to try to apply them. Then everything most likely is going to go smoother for you in the future.
Yeah, that's the thing with high quality lenders. Their goal isn't usually to bankrupt you. They're happy to
Right.
work with you if you're working with them, right? Like they
Exactly.
don't want to take the business over. Like the bank doesn't want to take over your house. They hate being a landlord. They want you to figure it out, right?
Definitely.
So
Definitely.
that it's always a good thing to keep in mind. Talk to me about just one or two quick real life examples of your funding working out for an entrepreneur. You mentioned the guy who bought the 5 businesses or so, or the three $1 million businesses. Is there any other example that comes to your mind?
I mean, we have many, many examples. I'm not sure where they'll feel comfortable bringing up their names for whatever reason. So I would have to check before with them in order to. But yeah, we've worked with a number
Yeah.
of aggregators that kind of used our financing to get traction quick. So let's say you want to pull up, you want to start an aggregator journey, right? How do you start an aggregator journey? So basically, you raised a couple of 100,000 from friends, family. You acquired a company or two. You feel comfortable that you can actually grow these companies. Once you acquire two companies, sorry, once you've raised capital from your friends and family, you can then go to Boopos to leverage that capital that you raised, right, and acquire a couple of deals.
Mhm.
Once you have acquired a couple of deals, then you can raise equity and talk to these private equity firms to raise equity. You raise equity, then you do it all over again. You leverage that equity with Boopos to acquire more deals, and then you talk to the debt lenders to kind of repay everything and restructure. So we have a lot of small aggregators that have used our financing to get traction quick. So they were able to have more leverage when they talk to VCs in order to raise capital. But we do have a lot of individual buyers that acquire very small deals and are doing so on a weekly basis. So I think last count was, I think we've done 17, 18 deals with you guys in the last year and a half. And we'll keep doing deals constantly. So I think we've really have a lot of success cases, especially with Empire Flippers, that we can talk about and kind of run them through stories. Just people that had experience, had a little bit of capital, not so much to acquire the deal they wanted, and they ended up using our financing. A few things that now that we're on a podcast, I wanted to mention is that when you go out and buy flippers, you could see a small batch for the deals that have been pre-approved for financing from Boopos, right? So if you see that batch, know that those deals have already been pre-financed. They have already gone through that underwriting process, and that if they wanted to acquire a company, they can do so, and they can know how much we can lend, right? And another thing is that if you're on Empire Flippers and you're trying to unlock deals, we all know that you need to show proof of funds for the whole capital of the acquisition price, right? However, we're
Mhm.
sending out support letters with buyers that qualify on our platform so they can unlock up to 5 times the amount of equity they're able to prove. So let's say you have 200,000 sitting in your bank account. That's how much capital you've shown proof with Empire Flippers. That's how much they will let you unlock listings. We can send you a support letter that will cover basically 5 times that capital, and then you will be able to unlock the listings up to 1 million on Empire Flippers using our support letter. So given the good relationship that we have, if you want to unlock higher listings, just go to Boopos, get a support letter from us, go back to Empire Flippers, show that support letter, and they will enable you to unlock those listings that are higher in price if they have been pre-approved by Boopos. I think that was something that I wanted to mention and should be mentioned, I think, to the buyers.
Yeah, that's good to know. And for everyone out there, Boopos is one of our partners. If that isn't clear by now, we've done a lot of deals with them. You said at 17 to 18 deals we've done. I'm looking forward to that becoming 126 here in the next month for the end of the year. So
We'll have to
you
take that
finance all the
letter.
deals on the market.
The last year
I
retrieval
won't
has to
force you.
make it on our castle. Once we purchase the
it-
castle.
yeah, if you're able to get an extra 100 deals in the next 30 days, we will buy you the castle. Maybe. I have to put the comment, maybe. But that's really good. Speaking of advice of going out there, there are a lot of bad sharks in the lending world. So is there anything like traps that people can avoid?
Yeah, no, definitely, 100%. First of all, partner it up with the right seller and the right broker, right? And that's something that we definitely recommend. A lot of people, what's the difference between other brokers in the space? We really have a good relationship with Empire Flippers. And one of the main reasons is that you guys work very, very well with the sellers. You make sure that all the information that you get is actually true, right? Because sometimes you acquire the business and the financials are not what you were told, or once you dig deeper, it's just like you start to get things out of the rug that don't feel good as a buyer when things have been hidden from you or when things are not true. I'm not saying that other brokers do. I'm just saying like when you work directly to the seller, you got to make sure that somebody in the middle is doing the right thing. So a good advice, like partner with somebody like Empire Flippers, that you really do a great job making sure that whatever financials or whatever connecting to the account and making sure that as much information is provided to the buyer from the seller in order to make the right decision when buying a business.
Yeah, that's really good advice. And a lot of times, like say you do go private, a lot of times the seller isn't trying to do anything nefarious to you by having their P&L wrong. They just happen
They
to be a
just
really
don't
bad
know.
bookkeeper. Like, yeah. Like, I mean, that's the case. I'm terrible with numbers myself. I like to think I'm a mini Richard Branson, like, because he always says he doesn't know how to read a P&L, but he's a billionaire, which I think is hilarious. But yeah, like, that
Right.
is such important stuff. And you're
Mhm.
absolutely right. You got to get that stuff correct. And when it comes to acquiring e-commerce and SaaS, is there any key piece of advice that you'd have there when seeking out funding?
Well, the one thing I would say is, first of all, create a strategy, right? And a roadmap. Some people are like, I want to buy an e-commerce and I'm just going to start talking to any vertical, any size, any type of deals, like really put into words a good strategy and a good roadmap in order to reach to that strategy or that final goal, right? So you want to buy an e-commerce, all right, just dig into deeper. What do you like? Do you prefer FBA? What are the good things about FBA compared to just e-commerce? Do you want to look at a diversified e-commerce that has a little bit of FBA or a little bit of e-commerce? What's the deal size that you really want to acquire? Be honest to yourself, because we see this a lot of times where buyer only has 50,000 in their bank account and they want to buy a $3 million deal because they read some book that okay, buy without putting any capital, which ultimately
Put
I'm
money
pretty sure.
down.
Right. I'm pretty sure there's a lot of ways and to get very, very creative and to buy a $3 million company without any putting any capital down. But just be honest to yourself how much capital you want to deploy. What's the maximum deal size that you could acquire with the capital that you have, right? And once you have the kind of a better picture of what deals you want to look in terms of I like this product just because I think it's going to sustain economic crisis or because I like sports and I want to sell
Mhm.
prototype sports. Once you know the strategy, once you know kind of narrow it down your search and then just start looking into what you're looking for. Because otherwise you get caught up into, okay, I want to acquire, let's say, a deal in the sports industry, but then you look at a baby product because it has a lot of really good margins. And then you look at a deal that's super big, you just kind of lose yourself in your own strategy, right? So kind of narrow it down as small as possible. And then once you have the deal, get the information, go to Boopos, see how much they get financed, and then start making different structures to know how to acquire the company.
Yeah, it makes sense. All right, we're at the end of the podcast here. So are you ready for the rapid fire questions?
Yeah, absolutely. Let's go.
All right, all right. This is the big moment here, Ignacio. If you get these wrong, you're buying the castle for me. No pressure. Just come up with the first answer that comes to your mind. So the first question is, what is the best hidden growth opportunity when it comes to the SaaS and e-commerce industries?
Something that really works with your own experience. So I would say look into your own experience, something that you can create, something you can bring to the table and just stick to it.
I like that. That's very good. I was hoping you were going to say Boopos, but that's an even better answer. What tools or resources would help an online business owner when applying for funding?
So first of all, have a great deal, have a good deal in mind. Make sure that everything that we mentioned has to be profitable. It has to have at least 24 months Some of the variables that we talked about are in range with what you would typically see on the market. Have the capital required, because we always require at least to have either 15% of the total purchase price or 25% of the lending amount, whatever amount is bigger. So make sure you have those in place before you move forward.
Makes sense. What has been your funniest moment working in the online business world?
I'm not sure if I should say this, but sometimes when we first started,
Not safe for
no,
podcasting.
yeah, no. But anyway, so well, it started Boopos. We have conversations, and sometimes it's just like you get into this conversation, especially at the beginning when we first started Boopos and nobody knew us and we didn't even talk to brokers. We were just trying to outbound ourselves to get finance to people, and you end up in conversations with people and in specific situations where it's just like too funny, and you're eventually having the call with them and you're like, what did I get myself into? What is this completely random situation that has nothing to do with what we do? But you end up in such these conversations and situations, and that's what I would say is the funniest moment I've lived in this industry.
The online world is so strange.
It
There's so
is, it
many
is.
like very odd niche businesses I've run across, or things that like, wait, that makes money. Like what? Like KDP businesses always like
Right.
strike a chord with me. Like what a crazy business model this is.
And you get on, and the
Oh,
conversations nowadays are all online. So you talk to people that are everywhere. The situations are different than when you met in person, because obviously you have to keep some type of, I don't know, kind of dress code or how you can present yourself when you're face to face, right? When the internet kind of sometimes it can get very creative. Let's put it that way.
my favorite on the dress code thing is during the pandemic when the lawyer's going to meet in court. One of the older lawyers, I think he must have like put a Zoom filter on for his kids, where it made him into a cat because he thought it was funny, but he didn't know how to take it off. So he's just like presented the legal battle as a cat. It's like the judge asked him to take it off. He's like, no, it's fine. I don't know how to take it off. It's fine. Let's just proceed.
Something like that.
Well, awesome, Ignacio. Well, this has been a pleasure. I feel like we could probably go on even longer, but maybe we'll have to get you back onto the podcast. So if someone wanted to reach out to you personally with any questions or Boopos, where's the best place for them to go?
Yeah, absolutely. So first of all, I would definitely go to Boopos, check out our marketplace, qualified as a buyer. You can start uploading deals. You can get in contact with us through the website. It's very easily. And then if anything's more specifically you want to reach out to me personally, feel free to add me on LinkedIn, message me at ignacio.villanueva at boopos.com. Anything related to this online space, and I'll be happy to talk to anybody really.
Awesome. Well, thank you so much for coming on. It was a pleasure.
Thank you very much, Greg. It was absolutely a pleasure for me.
There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry. And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace, or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.